manufacturing industry, GX of the transportation sector, promotion of carbon recycling or CCS, promotion of energy saving, mainstreaming of renewable energy, next generation innovative reactor, promotion of introducing hydrogen and ammonia, development of electricity and gas markets. So in summary, in order to accomplish our whole of economy challenge towards carbon neutrality, in addition to green projects, transition technology or activity is crucial in determining the speed and scope of energy transition. And government of Japan will facilitate transition finance as a powerful tool. And now government of Japan itself will provide giant 20 trillion yen through Japan Climate Transition Bond under our GX strategy. Thank you very much.
Thank you so much, Shinichi. Is one of the things that you said that it's really important to be holistic. It's really important to have this joined up approach to address the challenges in the different economic sectors together. So I'd like to go now actually to Nazmira, who is also online, and to throw open this conversation and ask the question, how are you in your organization engaging in transition? How are you using tools such as transition plans in your organization? And how are you almost providing this kind of convening, which is a point that one of my panelists made earlier, convening power between different sectors. So welcome, Nazmira. It's very nice to see you again.
Lovely to see you as always.
So over to you. Yes, an opportunity here to talk a little bit about how you in 91 as Chief Sustainability Officer are looking at transition.
I think the approach we've taken to transition is to put it at the heart of how we're approaching net zero. So I think when we started thinking about making net zero commitments, what was very clear to us as an asset manager with quite a large proportion of our total AUM in emerging markets, just around 55%, a strategy that focused on portfolio decarbonization alone was likely to have large unintended negative side effects, namely sucking capital out of the high carbon portions of the world, which is what emerging markets tend to be. Therefore, we designed our targets to focus around engaging with companies to try and catalyze the change. And unfortunately, many of the markets that we operate in are not as coherent as Japan is at this point in time. There are differing levels of ambition, some very high levels of ambition. For example, what we're seeing in India or China, or even increasingly from Brazil at this point in time. But by and large, there's much more contestation. So what you want to do is have a fairly transparent process in which you engage with the companies that account for the bulk of your financed emissions. So I keep using the statistic when I speak, so apologies if someone's heard me use it before, but we have 1,200 holdings across the house. And if anyone wants to take a guess on what proportion of those emissions account for 50% of our financed emissions, think about that for a moment, 50% out of 1,200, the answer is 24. So quite a concentrated number of companies account for the bulk of our emissions. And in order to facilitate our assessment, we developed a transition plan assessment framework, very much aligned to the transition plan assessment guidance that CBI has just put out. But we assess the ambition of the targets, the quality of the plan, and the implementation of the plan. And we are understanding within that fairly focused group of companies what's within their control, what requires government action in the regions they operate in, and what we can hold them accountable for. So I think that's a pretty long-winded explanation, but I think the bullet points are we think transition plans are critical, and we think understanding the interlinkage for companies between the policy environment and what they can control is really important in order to see tangible progress being made. Because it's not just about what companies promise on a emissions reduction basis, it's about the plans they make to achieve that.
Couldn't agree more. And thank you very much for the slight plug there for the climate bonds guidance that we just published. That's great. I'll go over to you, Thomas, with the kind of the same question. Is that how are you using these tools in MUFG, but also as part of the Net Zero Banking Alliance?
Sure. Is this on?
Yep.
Okay, good. So first of all, thank you very much for the invitation. Glad to be here to talk about our meaning, not only MUFG, but how banks are trying to achieve its own target. So I sit on the Net Zero Banking Alliance steering group. Actually, I have a board meeting in 1 hour or so. I'll be probably a little bit late. But what we are discussing, we launched this Net Zero Banking Alliance 2.5 years ago. This was 6 months before COP, Glasgow COP. Since then, we've been discussing many agenda, but one thing that we now agree is our theory of change, which is about whole of economy transition. Now, if I say it has to be whole of economy transition, I assume most of you will agree, but 2.5 years ago when I said this, some banks, some stakeholders actually said, what are you talking about? It's got to be investment in green. It has to be green only, and you should be divesting from your exposure to brown or, dirtier sectors. But I said that will not bring us to 1.5 degrees or low carbon economy. Simply, if you think about it, especially for banks, maybe that's not necessarily the case for asset managers, but for banks with sizable balance sheets like ours, which is almost $3 trillion, we have existing exposure to all sectors that you can think of, not just green, not just, light brown, but brown, very brown. We have existing exposures to these sectors today, and we need to support their transition. That's why it's all about transition, not just, what I would characterize as a top tip of the iceberg. You cannot just, finance these companies and hopefully the whole of economy will transition. No, you need to support the entire ecosystem, whether it's Japan, whether it's Asia, Europe, UK, et cetera. That's why it's all about transition. And what we are trying to do within Net Zero Banking Alliance is to develop a tool to facilitate financing to all companies in the ecosystem, as opposed to just thinking about the tip of the iceberg. They may have credible transition plan, which is great. Those companies, you said license to operate. Yes, these companies will have credible transition plan. Does that mean let's say, smaller companies or, those companies with smaller team in the sustainability planning or strategy, we don't have to finance? No. But that's where we think banks have important role to finance the whole economy. But of course, we want asset managers, institutional investors to do their role as well, because, even if our balance sheet is reasonably sizable, still it's not big enough if we think about the huge funding gap that exists. I want to stress especially about Asia, given we're headquartered in Asia, but at the end of the day, even if we were able to finance give sufficient finance to, let's say, automotive or buildings here in the UK or in Europe, US, if we do not finance or give the sufficient transition finance to Asia, we're toasted, we're barbecued. And this, this is not going to be a livable planet anymore. So what we are trying to do within Net Zero Banking Alliance, but we are also doing that in the context of our transition planning, is how do we mobilize finance to the highest emitting sector in the highest emitting region, which in my view is energy transition in Asia. So I know and I'm sure you will be discussing what you're doing here in UK or Europe, and I'm not trying to underestimate the effort there, but at the end of the day, the money needs to flow where emissions are. And I think that what we need to, something that we have not been discussing sufficiently, is how do we mobilize finance to energy in emerging economies? And again, if we do not provide sufficient funding, just give you one data point, there are 5,000 coal power plants in Asia. Is it manageable? No, but 5,000 have to go down to not zero, but reasonable number in the next 30 years. That means we need to shut down like hundreds of coal power plants in the next 30 years. Do we have all the tools? Do we have the finance to do that? I don't think so. That's why GFANZ, Net Zero Banking Alliance, we're talking about this managed phase out of coal power plants, but we need financing for the purpose of early phase out of coal power plants. As I said, there are 5,000. Of course, you can criticize who built all these, but it would be too late. Just criticizing will not solve the problem. So again, we need to do finance, IRA, all these initiatives in the US, Europe are very important. Japan, as you heard about GX, but I think what we're missing at the moment is more financing towards Asia. Happy to come back. What policymakers then can do to do more of a financing there. But that is the critical thing that we're trying to address within Net Zero Banking Alliance, but also in the context of a transition planning of the MAFG, which we hope to publish in April. So happy to come back when our transition plan is published, but that's where we are. Let me stop there.
That's great. And I couldn't agree more about the energy transition. We talk about it a lot. A colleague is running a session on energy transition and electric utilities later. So it's a critical aspect. But I'd like to turn now to more of a real economy perspective. So we have two representatives here who are representing industry and buildings. So I'll turn first to Mariam from the GFG Alliance and Liberty Steel particularly. Again, the same kind of question from a industry actor, from an industry stakeholder. How are you using the concept of transition? What do you need from other stakeholders, and how is this working in your sector right now?
Yeah, so this is all music to my ears, this transition piece, because we're not going to sell anyone on our green credentials today, right? We produce 2 tons of CO2 for each ton of steel that we make. So for us, it's all about what's the journey, what's the end point, and how do we get some meat on the bones of that? And I know we've already had mountains and sticks and carrots and icebergs, but if you'll forgive me, one more analogy. I was at a conference recently and I watched as the audience was held enraptured by the speaker talking about how he was going to tell them how to win the Masters Championship. And, there was initially sort of disbelief, and then he really convinced them, just listen carefully, and I promise you, I can tell you exactly how you're going to win the Masters. And he delivered this 3-step plan, which was 1, you turn up, you're confident, you keep a cool head. 2, you navigate amen corners, so stay on par. That's really where this is won or lost. And 3, you take a 2 under par strategy. And by the end of the 4th day, you'll be 8 under par, which should put you in the winner's circle. So that's great. I mean, that strategy will win you the Masters. And it really hit me and resonated, because transition plans are a little bit like that. So I'm writing down what we're going to do. So we're going to invest in electric arc furnaces. There's our first strand. We're then going to think about what's the solution for primary steel production, because we can't meet demand just from electric production. So we'll use hydrogen to directly reduce high quality iron ore. And then we'll use that at stage 3 as feedstock back into our electric arc furnaces with scrap. And there we have our solution. Right, well, great. But will I win the Masters? No. Can we transition in that way? Well, I hope we can. But from an investor perspective, so I sit on the board of a large institutional investor with my other hat on. How do I, looking inwards at this company, determine that that's likely to happen, that we have the criteria in place and the governance approach that will deliver that? And importantly, as we heard this morning from Sean, what are the resiliences? So if we don't do that within the right timescale, what impact does that have on our operation? What could we pivot if we don't see some of the contingencies coming through that we're after? So I think it's really, really important for us to be able to articulate that technology readiness, whether these projects make sense in a business perspective, and then how are we importantly dealing with some of the other aspects that sit alongside this? So it's not just the decarbonization pathway, but how are we dealing with things like industrial relations? So if we have union engagement that isn't successful, is our decarbonization path going to work? If we can't get our our communities on board with the idea that this is really good and this will create jobs, they'll block our permitting requirements. So these are not soft and fluffy things about helping a just transition. This is real hard business case requirements that we should be able to demonstrate to investors that this is something that we're thinking about. This communities, people, skills aspect of the transition is as important as can we get hydrogen on stream at the scale that we need it, in the locations that we need it. So I think there's a lot there, and it's very difficult to put that all into a couple of pages. that can go into the public domain without commercially sensitive information, that's digestible for all our potential stakeholders, whether that be government, unions, investors. So I think all of the initiatives that are starting to come together around the SBTi targets, I think that's really helpful. We're engaging with Responsible Steel to get some of our sites accredited. We're looking at the Climate Bonds Initiative framework. Again, where are our gaps? What are we going to need to do in order to fill those? Huge data collection effort. So if you think about a global steel manufacturer, I spend a lot of my life running around after our CEOs, trying to get the information from them to put into these transition plans. LCAs, EPD. So there's an awful lot of work around verifying each strand of this. But I think that's really welcome when you look at the amount of money that needs to flow into some of these transition plans. Reducing the amount of work that investors and other stakeholders have to do to unpick them, I think is going to be really important to unlock that, because it's not realistic to expect that representatives from various investment houses are going to come and talk to me for 3 hours about our transition plan every time that we need to have a conversation.
Yeah, simplification is key for this. I'm going to pass over to Christina, but I would like to point out, we will have a Q&A at the end. So please do be thinking about some questions. We've got some people who'll be running around the audience with microphones. So keep your questions in your mind, but over to you, Christina.
Thank you so much. So I work for an NGO that has members in 77 jurisdictions around the world, the World Green Building Council. And we've been collaborating, I think, for many years with a lot of actors here and beyond, making sure that there's the right sorts of capabilities and the right sorts of policy and vision to be able to unlock the potential to decarbonize an asset class that actually buildings, if you think about it, 2/3 of all assets in the world are real estate. So the decarbonization pathways for these asset classes that actually we use day in, day out in our lives are critical. And you saw just in the plans, that amazing transition plan, there is an understanding now more and more that there's some elements that are coming into policies around how can you improve the energy performance of buildings. So it is super exciting times, because it is finally happening for this sector that has been a little bit flat in terms of innovation. And you're hearing now more of capturing the attention just behind the wave of the electric vehicle, understanding that buildings, if you put buildings in the same sentence, it's exactly the same logic. So it's amazing to see today that there's an understanding that 40% of energy-related emissions from the consumption of energy comes from buildings, because they are inefficient in the use of their energy, because they are starting just to capitalize on the renewable power generation. And if you think beyond of the systemic thinking that we're having here today in this amazing panel, actually a zero carbon building in the future is also grid responsive, meaning that it will help decarbonize the grid if buildings are aligned with the energy transition. And that is already happening. There are standards coming out in Hong Kong about grid responsiveness. There are standards coming out in many geographies that are the next frontier. But in the meantime, how are we getting there? We're critical, the built environment is a critical demand signal for what you were sharing, for key industrial sectors to be able to decarbonize, because all those efforts, if there's not the demand, well, there has to be at some point a coming of the markets to be able to unlock that potential. So I would say there's a few things that are coming into place. One, there is like that inevitable policy response that is coming from transition finance, understanding that the existing building stock is sufficient in the developed world, that we should be, the first principle would be renovating, retrofitting existing building stock. They have a huge carbon debt to pay, and we can mobilize that transition finance into getting into that retrofit scale that we need. We know that it is possible, it is doable. In the EU, there's a critical conversation on the Energy Performance Directive. We're getting there, right? Beyond the politics, it is getting there. That's one point. So the transition finance, unlocking that into an asset class that can have those huge benefits, is key. And there's a saying, the cheapest energy is the one that we don't use, and that is energy efficiency, because there has to be that co-responsibility of reducing energy demand in high emitting or high consuming countries to make space for the developing world to be able to develop. But also, and I agree, there has to be an emphasis on Asia and let's say enabling that transition. But we also have to think that the transition also is built in geographies that are going to be still urbanizing at a high rate. So this coming of terms of monitoring, disclosure, understanding that it's not enough just to design and pull out of the idea of performance management, energy audits, disclosure, ongoing performance is going to take us to a next level of digitalization, disclosure, data management, and that all of us have in our app how to manage the energy we consume in our homes, in our buildings, everywhere around the world. And there's a social piece to this. And it's all those efforts that we will put in this finance, in existing assets or in new assets, we have to understand that there's still geographies that I said urbanize at a high rate. So the efforts we do in decarbonization, they have to go hand in hand with helping those geographies that have energy poverty like Africa and making leapfrog into the clean energy transition. And that, let's say, collaboration is going to be key to level out the inequality of the energy access and the inequality of the transition finance. It's the building the transition finance, right? And so we need to be also, let's say, be fair and just in how we roll out that collaboration to be enabling that systemic thinking happen.
That's great. I'm going to pick up on one of your points is collaboration. This brings us to the kind of the second question. We're going to need to, unfortunately, speed things up a little bit. But the next point I'd like to kind of put to you all, and Nazmira online as well, is what do you need from the different actors in this ecosystem? So as a real economy representative, what do you need from the finance? As a financial representative, what do you need from the real economy? What do you need from governments? In order to really operationalize this transition and can like get us running rather than where we are at the moment, which is walking quite slowly. So I'll go first actually to Marion on this one. Is that, and if we could kind of keep it to about 3 minutes,
Yeah,
that'd be great.
Just pick me, you're in picking.
Oh yeah, okay, yeah. So
Yeah.
what do you need from the different actors?
So I think the first thing is to understand the opportunity that exists here, right? So if you look at a business that currently produces 2 tons of CO2 per ton of steel, it's easy to say, well, you know, that's not going to work. And the steel industry is 8% of global emissions at the moment. But revenues from steel today are $1.7 trillion, and they're expected to increase by over 50% by 2050. So we can't get to a net zero world without a solution for net zero steel. So there's a real opportunity there, I think, for asset owners to mobilize the pools of capital that are needed to accelerate this transition. And those pools are huge. So it's not only the plant level CapEx, which is probably around 6 billion a year on average, but it's the trillions that are needed for the renewable energy infrastructure, generation, distribution that's going to have to sit alongside this. So I think there's a huge opportunity there. The partnership opportunities are really interesting. So we're seeing different ways of actors across the value chain coming together. So if that might look like us using our high quality iron ore directly reduced with hydrogen that we're working with the South Australian government to produce with direct offtake links. So that de-risks the whole thing for the investors. And that can then be used to our onward supplies of low carbon embedded product that they can use in their electric arc furnaces, thereby de-risking the industry. So I think there's a whole real interesting piece here about how the different actors come together in new ways of collaborating across the value chain. But you talked about challenges. I think we have this issue with fragmented policy. So whether that be licensing permits, carbon tax, different standard regimes, that's really difficult to start to work around, particularly as a global organization. We have evolving technology. We have the need to scale rapidly. So that's going to cost money and require early stage investment to something that isn't necessarily proven. So I think the only way around all of these is more collaboration. So for what should we do as corporates? I think we need to work much more closely with governments and investors, our suppliers and our customers to demonstrate what's in it for them. We need to understand and deliver the information requirements that are out there. And it's a vast amount of information that we're going to have to, and it's back to your point about this digitalization and openness of information that we're going to have to share. We need to build credible transition pathways that people can understand and really engage with accreditations and standards. And we need to do our homework on local permitting and rules and regulations. From governments, what we'd like to see is really consistent and transparent policy frameworks. And importantly, this public procurement and supply piece to drive that market demand, so that it's a much easier conversation for industry when we're looking at our different stakeholders to say this makes commercial sense. From finance, and I think we've heard about this happening already, much closer integration with industry and government. So co-developing solutions in a flexible way. And I think where we've seen this really successful government-private partnerships happening is where government-owned actors take the first ownership piece and de-risk that for others. And then that opens the door to a diverse equity pool, export credit agencies, off-balance sheet financing templates. So I think it's then really saying, well, how do we bring all of this together in quite a flexible way, which isn't the way that might traditionally have been operated. But I did hear said the other day, which again really resonated with me, that what's driven successful financial outcomes over the last 5 to 10 years is not the model and the approach that's going to deliver successful financial outcomes over the next 5, 10, 15, 20 years. So I think it's a really good time for us to all think about how can we structure things differently to start delivering the outcomes that we're looking for.
That's great. And I'd like to, that's from a real economy perspective, and there's some really interesting points. I'd like to go to Nazmira now from an asset management perspective. Nazmira, are you still with us?
I am. I haven't run away as yet.
Fantastic. So over to you on the same thing. What do you need from the other actors in this space? You talked about engagement earlier.
So I'm going to talk about what I need from the other actors, but also what I need from other pieces of the financial sector. Because I think Tomohiro picked up on a really important point, which is if we are going to be serious about this whole of planet transition, not just whole of economy in individual countries, it's actually the whole planet. So in 2022, 63% of emissions came out of emerging markets. So if we don't address emerging markets, we aren't going to resolve our climate crisis. And the reason I emphasize this fact is because the appetite in the developed world right now to fund transition-related investment in emerging markets is actually quite low in the institutional savings pools. Banks are making progress. So I laud the progress that banks like MUFG are making, but I think we need to see this expanding. And how we deal with that is not clear to me. So that's the first thing I put on the table is, something slightly different from the engagement and transition plan assessment that we've been talking about, is how do we actually think about funding between regions at this point in time? Because the IEA tells us that China is the only emerging market that can self-finance its transition. So that's my first point. Closer along the lines of what Marian's been talking about, what we want to see from companies as we engage with them, wherever they're located in the world, is transparency and consistency. And I know that asking for consistency in financial reporting is often a big ask. So asking for consistency in transition plan reporting is an enormous ask. Right now, all we're asking for is consistency year to year, but ultimately what you want to get is some sort of sector level consistency so you can compare progress on plans. But the more that companies can be open with us on why they've progressed or why they haven't progressed and what the obstacles are, the better we can get an understanding of what is actually happening. And then from governments, I think Marian's explained this far more eloquently than me, but I'll summarize it with the same words. is certainty and transparency. So transparency and consistency, and as much as it is possible in something that is fast evolving.
Fantastic. I couldn't agree more on the transparency and the consistency and the ability to compare across sectors and across companies. It's so important. Over to you, Christina, and then Tomo, you'll have the last word on this, and then we'll go to a Q&A.
Thank you. Yeah, and I won't duplicate. I totally agree with what has been said. I think that part of third-party verification, transparency, from our side, we have worked to build a lot of capacity around green building certification systems. But now, as I was saying, they have to move towards performance-based. So the ask would be that governments put in place performance-based energy codes for all buildings around the world. I was just seeing in this plan, the measure was just changing insulating windows. That is not enough. That will not get us to Paris. We need every single country to be putting those codes and following through, because without those sort of thinking and linking it back to the mechanisms to bring the scale to actually what climate bonds and others have done, using all these standards and all this transparency to build the markets and to bring accountability, we can have all the charts and pathways, but it won't happen. And in terms of the not yet green assets that the banks have, I would ask that you put them on a pathway with those transition funds of deep decarbonization. But that cannot be that asset classes are dumped because they don't fit with the chart. They have to be retrofitted. And then we have to deliver on the retrofit economy. So I would ask that we build that business model into the banking structure, that we build the retrofitting economy business case. And that will change a lot of lives, and it will change the scale of what is fit for purpose in terms of those pathways.
Fantastic. And Tomo.
Sure. So 3 minutes, 3 points I want to raise. So in short, what I want to see is more of a encouragement of transition finance, not discouraging. What do I mean by that? First of all, finance mission, we committed to net zero, and we also have many of us within Net Zero Banking Alliance, we have 2030 interim target for the finance mission. It's our voluntary target, so we need to hit that. But at the same time, the conundrum that we're facing is that we need to front load, not we, but the real economy has to front load the investment for us to, if we were to achieve 1.5 degrees, investment has to take place now, not like 20 years from now. So we need to finance those high emitting sectors to transition, but that finance may increase our finance emission in the short run. So there's that, we're trying to reduce while there's possibility of increase of finance emission. And Kiara-san a few minutes ago touched on this paper that METI produced, which I think is a great one. So I would encourage you to read it. That discusses, this trade-off that exists. But we're trying to, we're not trying to green our balance sheet and let somebody deal with the real economy transition. We're trying to address the real economy transition, which will allow us to achieve net zero of our balance sheet or of financial institutions. So that has to be the order, as opposed to just, focusing on greening our balance sheet. So that's number one. Second, de-risking. I think we heard from the Arun from the World Bank. We're also involved in the discussion with the World Bank about their capacity to de-risk. In Europe, advanced economies, but especially in emerging economies, many infrastructure financing are not necessarily fit for purpose or not necessarily something that you can invest or bankable. So we need a public institution to come in and de-risk these transactions. This is clearly an important enabler, but we are still waiting for the MDB, World Bank, ADB to come up with their reform. They're trying everything, but at the same time, they have tons of shareholders to deal with. So it may take some time, but clearly blended finance de-risking by the public institution is critical. Third and lastly, personally, I think oversimplified narrative is counterproductive. Based on our engagement with our clients, I met with numbers of clients in Japan and Asia. They're doing everything they can. Of course, you can criticize as, they're not ambitious enough, but thinking about all strategic challenges, many of our clients are doing what they can in terms of corporate investment and strategy that they're developing. So we believe we're more of a We should encouraging, you mentioned about masters. You don't want your player to say, oh no, you'll never get there. So don't, let's not try. It's better to encourage you. You need to continue to say, you can do it. You can do it. Let's do it together. So that way we characterize our relationship with our client is your success is our success because your mission is our mission. You don't want to discourage your client to do more. You want to encourage. So what I want to see from the government and investors, all stakeholders, is encourage to do more as opposed to discourage, kind of say, oh, that's greenwashing, that's not good enough, that's you're not on the pathway. Why would you want to discourage you? We should try to encourage. So what we have to do collectively is to encourage investment, and we all need to expand our risk appetite. We banks, but asset managers, investors, all of us need, and the World Bank included, we need to expand the risk appetite so that we can address the huge funding gap. If we kind of narrow the risk appetite, we're always talking about this $1 trillion of funding gap. Who will fill that? So we are trying to do that, and we encourage all of you to expand the risk appetite because, as we just heard, we're trying to address this planet level challenge and we need huge funding, especially to emerging economy and energy transition. Let me stop there. Thank you.
Thank you so much. So I will open the floor to questions now. I can see 1, 2, 3. Oh God. Okay. We're not going to have time to get through all of them, I don't think, but I saw this one come up first, the gentleman in the middle with the black tie and the black suit, and then the lady behind in the blue, and then gentleman in the white shirt and black suit over here. So you first, sir.
Hi, my name is Saurajit Iyer. I work with Octus ESG. We work with financial institutions in sustainable finance, climate risk. And my question here really comes from the industry, especially aimed at Marian and Tomohiro. This is about the offshoring and reshoring of emissions with respect to transition plan. And what I mean by this is, if you actually look at some of the countries who have actively reduced their carbon emission levels over the last few years, coincidentally, many of them are countries where the real GDP has generally been in slump over the last few decades, especially in the manufacturing/industry segments. A lot of that has migrated to China. So technically, a lot of that emission has now become scope 3 emission for the UK, France, Italy, so on and so forth, Japan included. A lot of that is now migrating to Vietnam, Cambodia, all those places. However, populism politics, something that Sean mentioned in the morning. Now, we saw that in 2016 in America. We're seeing phases of that in various countries. If that increases and there is a need to pull back that offshore GDP, real GDP back into these countries, how prepared is the domestic industry's transition plans in that context? That will they be able to cope up with this incremental GDP rise that has to be made? Or will the current transition plan suddenly, fall disjointed in view of this really incremental real economy need? Just wanted to get a sense of that. Thank you so much.
Okay, thank you. I'll take 2 more questions and then we'll kind of put them to the panel altogether, if that's okay with everybody. So, lady in the blue, I think. Yep.
Thanks very much. Thanks to the panelists for this really insightful session. My name's Celeste. I'm from a company called Meridian Economics. We're based in South Africa and we often work with companies on their decarbonization strategies. So this question is directed to those who are in the process of developing transition plan assessment frameworks. In our work, obviously in the South African context, we're a heavy industrial economy. We often run up against the problem that we're dealing with a company that doesn't necessarily align or fit the mold of sort of a sector level transition assessment plan framework. And requires something potentially a bit more bespoke in order to assess their transition strategy. It would just be useful to understand about how you approach these types of companies and how you gain comfort that they're actually undertaking a credible transition pathway. Thanks very much.
Thank you. And gentleman over here.
Hi, Tony Rook, formerly head of transition finance at GFANS. I've had the pleasure of working with a lot of you already. Totally agree with what the panels talk about. It is about financing emissions reductions in the economy. It's not about reducing financed emissions. Fantastic to hear that. I'd like to ask a very specific question for you, Tomohiro, and for Nazmira, if she's still there. What importance or how much of the transition plan needs to be about policy engagement, given that policy we've seen in the US, in Europe, in Japan, is driving much more change than potentially we can see from individual companies' actions.
Okay, thank you. So we'll start with Marion and Tomo, a couple of thoughts on what would be the potential impact of re-insuring the offshore impacts of real economy emissions and how that would affect transition plans. So let's come first to Marion, a couple of thoughts, then to Tomo, if that's okay.
So I think it depends on the country, the extent to which they're able to absorb additional scale requirements and still meet the plans. And I think it's this really interesting question of emission intensity versus actual emissions, because for us, if we're able to produce more volume, actually in many cases our emission intensity goes down because we're able to be more efficient. And I was talking to a number of colleagues up in Rotherham yesterday at one of our sites. Some of the trials that they're using e-coke, for example, in the furnace, actually, if they can put more volume through, that's more useful to generate results. So I think there's probably some benefit to having more volume going through those economies. So what we might then see is an initial uptick in the actual emissions, but that could then facilitate a greater speed of decarbonisation as a result of having the benefit of being able to do that. What I think we'll also start to see is a supply chain reconfiguration. So what we're thinking about is how do we take advantage of the specific conditions in the areas that we operate? So if we look at Australia, for example, high quality magnetite, lots of wind, lots of solar, and a supportive government. Then we've got Romania, wind and solar. We've got others that are close to the market. We've got others that have got really skilled people. So how do we make sure that we're producing the things that are best produced in those locations that have access to high quality renewable energy at a lower cost, and do other things in other places? So not necessarily being wedded to the old model of production. And I think that's probably something that we'll start to see as different countries start to think about what do they need to produce onshore versus offshore.
Thank you. And Tomo?
Should I address the first question or should I?
Yeah, the first question, because the second question I'm actually
I'll try to
throw to Nazmira if she's
so I'll try to address three of them if that's okay. So on the first one, the good news is whether it's a good news or not, I'm not sure, but we are in case of MEFT, we have a subsidiary in Indonesia, Vietnam, all these emerging economies. And for example, we're sixth largest bank in Indonesia. So we're not just Japanese, or we're not just operating in advanced economies. We're operating in Asia as well, and that's why we have skin in the game for the decarbonization of emerging economies. So whether it's a factory in Indonesia or Japan, wherever that moves, we want to make sure that we help their transition. So that's how we are thinking about. So that's why it's about global whole of economy transition as opposed to just looking at Japan only or UK only. So that's our approach. That's another reason why we're involved in JETP, Just Energy Transition Partnership, which is the G7 project, because we know, and that also goes to the question from Tony, which I'll come back to. It's especially in Asia, it's all about energy transition. That's why I said it's the highest emitting sector. That's where the money needs to flow. Energy actually produces more than 50% of CO2 in Asia. So that's where the money needs to flow. If not, all other sector cannot decarbonize, right? That's a very natural consequence that you can think of. So that's why it's about for us, it's about Asia, it's about energy transition. The second question about the bespoke, this pathway, that's another excellent question. And that's maybe different what banks can do versus what institutional investor can do, because we talk to our clients every single day, not every day, but every week, every month, we talk to our clients. So we do all the due diligence. So that's another reason why as I said, oversimplified narrative is not useful. our clients, especially global companies, they're operating in multi-regions and so many business lines. So it doesn't make sense to go to a leading Japanese company or Asian company and say, okay, here's the pathway for you. Are you on the line or not? That's not the type of due diligence you have to be doing. You have to look at their geographical footprint, business lines, and you have to look at their pathway one by one, as opposed to just try to kind of see whether you're on the pathway or not. So that's the business model of commercial bank. Maybe that's not what the institutional investor can do, given you're more reliant on public information, but that's the role that we play in the context of facilitating transition of our clients. Last one about the question on public policy engagement. What we learned throughout this 2.5 years is that, as I said, we have to be focusing on energy transition, but in the context of energy transition, this is not just about CO2 reduction. The flip side of energy transition, we have to think about energy security, right? That's not something we alone can address, or one by one our clients cannot address. This is why the government, the industry as a whole, we have to sit down, discuss how can we do this, right? We need to think about just orderly transition. All of these have to be part of the equation, as opposed to just focusing on the reducing your finance emission, as you mentioned. So that's that's where I believe the government policy intervention is required, and the predictability and also the pathway, as Kihara-san mentioned. All this will help us in developing our transition plan. Let me stop there. Thank you.
Thank you. I have a big clock that's flashing in front of me, and I'm just wondering if something explosive is going to happen, but it stopped, so it's fine. Is Nazmira Mira still on the line?
Yes.
Oh, wonderful. I wanted to actually throw the question to you about entities or actors that don't fit this kind of sector-based pathway, and how you interact with those, because I know you have quite a few on your books that you're working quite closely with.
So I think our approach is actually quite similar to Tomo's approach. Is one of our departure points is that assessing alignment is more art than science at this point in time. Adjusting for sector and the combination of sectors that companies operate in requires judgment, because there aren't a whole lot of neat boxes, and some sectors don't have any pathways of note as yet. So there's that element. The other element, which I think is often massively underappreciated, is the importance of country adjustment. I think because this is so difficult to do starting at the sector level, we don't then seek to make country adjustments, but we do know that our climate commitments are based on this idea of common but differentiated responsibilities. So a cement operator in Germany should be decarbonizing faster than a cement manufacturer in India, for example. And therefore, as we assess a company's targets, if we think about those 3 pillars: targets, plan, implementation, we assess their targets, and whether we think their targets are aligned, we take into account both sector and geography. And I think the important thing is you want the accountability that comes from that. You want something that you can hold the company responsible for delivering, but it's not going to be like a tick box approach where every company has to deliver the same percentage change just because it nominally falls into the same sector according to MSCI. I think that would be a little bit of an irresponsible way to do it. Is it worth answering the last question while I'm at it, which I'll try and be short, which is the importance of companies engaging on policy. One, we think it's actually really quite important on an overall basis, but the materiality differs by sector. So for example, in the oil and gas sector, I'm increasingly coming to the conclusion that engagement with what can we legitimately ask an oil company for? And a big part of it is, what are their lobbying positions? What are they asking governments to do? Rather than expecting them to simply reduce their production to zero over some short-term horizon. Because it is about addressing demand for oil. And if any oil company claims to be net zero aligned, then we would expect to see a very strong aligned lobbying position that goes alongside that. I've yet to see that from any oil company. In contrast, in the mining sector, I think the government engagement is probably less relevant by and large. In heavy industrial sectors, which require massive fiscal support and perhaps even tax support, you would expect to see that sort of government engagement coming from those sectors.
Thank you. And very quickly, last thoughts from Christina on the policy aspect, because you did mention before the importance of policy in the building sector. So very quickly, and then we'll wrap up.
Very just remember the ambition loop also from Paris, right? And from it is critical that yes, businesses drive forward, showing the vision of the possible, starting the innovation. We've heard it in Race to Zero campaigns from the high-level climate champions, what GFANZ, others do. But at some point, there has to be a policy response to match that ambition, to move the market to scale.
That was brilliantly short and sweet.
Yes, I tried to.
So I'm very sorry we don't have any time for any more questions, but I would like to thank my lovely panelists, Tomahira, Christina, Marion, and Nazmira. So give me a round of applause, please. And I hope you enjoy the rest of the day. Thank you very much.
One moment, please. Take your seats.
Please, no one leave. Sean
Because there's an
has a-
on-switch moment. We have 3 minutes. I have my good friend, Azim Qureshi. Please come up, Azim, who's going to do a 5-minute on-switch. He's the chair and CEO of the 2050 Inc. Massive clean energy portfolio. Take it away.
All right, awesome. This is like the worst timing. Like you guys want to get out there, have lunch. I'm starving myself. So thanks, Sean.
Tick, tick, tick.
Okay, right. I'll get going. Okay, all right. Where do I start? I got lots to say, so that's not fair. But so I'll give you a bit of my background, who I am. So I started in this industry 17 years ago. I'm an engineer by background. And at the time I started, you know, everyone thought I was a tree hugger. And I said, look, I don't wear hemp clothing. I don't smoke dope. So, you know, I'm just an engineer and we need to build a better world. So we started with, you know, investing in solar and efficiency as well. Long story short, I raised a lot of capital. You know, we own $1.8 billion in assets. We have a $5 billion pipeline of projects. You know, so if you're an investor, please come talk to us. That's what we do. We continue to raise capital. And I'm not going to know that's you unless you're holding a bag with a dollar sign on it. So anyways, so and recently what we've done is we've raised another $4.2 billion as discretionary capital. So I can write that check out to various countries around the world. So we are in Canada, US, Japan. We've actually made investments. These are operational projects that we've done. We work with government stakeholders. We've done all that. Everything that's being talked about, we've done it. We've had fights with them. We've had hugs with them. We've done it all. So that's what we do. And so the idea was what we've done is we raise these proceeds through a bond structure. And traditionally what happens is the capital comes in after projects have been de-risked. So what we've done is we've turned it around. We said, look, we're going to raise the bond. We're going to do that structuring. That's what we do. We understand it. And now what we're doing is we're placing that capital. So in a year, 2 years from now, you know, when the projects are de-risked, that's when the bonds can come in. We're also in negotiations to buy a bank. So we just want to buy a bank. So the premise of the bank itself is to operate it as a green bank. That's what it does. That's the premise. That's why it exists, for example, to flow the capital and certainly take on early stage risks. That's something that institutions just simply can't do. You know, and you know, obviously we've heard from the gentleman who was here from MUFG. I'm sorry, I'm forgetting your name, for example. But the point is that from loan to value, they're not going to come in for 100%. Okay, so the equity needs to flow. That capital needs to come in early stage. That's where, you know, a lot of problems happen. Okay, so anyways, so I'm trying to keep it short. Okay, is that, do I got 2 more? Can I keep going? Okay, wrap it up. Okay, all right. So anyways, and one of the things we're trying to do, we're working with Sean, obviously, is to, you know, be the first organization that at a entity level is certified, right, with CBI. And this will allow us, you know, as opposed to entity or project level, so we're able to, you know, raise capital on a continuous basis as opposed to getting it certified every single time. So it's the entity as a whole that's doing that. And the idea is to obviously expand that across to other organizations. Okay. So anyways, thank you all for everything you guys do. We're the guys where, you know, the rubber hits the road and, you know, we put shovels in the ground and make it happen. Okay. Thank you, Sean. Okay. Thank you, guys.
They're applying to be the first organization to receive climate bonds certification as an entity, as an aligned company. Companies with a good transition plan can also get certification. From the previous session, you've heard stories. This is a new idea in the certification scheme to confirm the environmental credentials of everything that a company does. Watch this space. Please join me outside.